3 years ago, you could buy a kilogram of gold for $50,000. Today, that same kilogram costs over $100,000. Your gold just doubled while your savings account grew by 3%. But here's what most people miss. This didn't happen randomly, and the timing is unusual. Central banks around the world have been buying gold at record levels for 3 consecutive years, not months, years, and they're moving it out of Western vaults and back to their own countries. The question isn't why gold went up. The question is, what's driving central banks to act this way, and what does this pattern of behavior tell us? I'm going to show you the 4 problems in the current monetary system and why certain institutions are changing their behavior in ways they haven't in decades. Because when you understand what's actually happening, you might reconsider how safe your savings really are. Let's start with the obvious problem that somehow nobody wants to discuss openly. Governments print money. A lot of money, not because they want to, because the math forces them to. The United States alone owes $36 trillion. That's a number with so many zeros even mathematicians get tired counting them. And here's what the numbers show. They can't pay it back with real value at current tax rates, so they pay it back with printed paper. Think of it like this. You have a pool of fresh water. That's your savings. Every day someone adds salt water to the pool. At first you don't notice. The water still looks clear. But after months, the entire pool is salty, undrinkable. That's what's happening to your money right now. 5 years ago, $100 bought you 10 bags of groceries. Today, that same $100 buys 3 bags. Your paycheck might be bigger, your bank account might be growing, but your actual purchasing power is evaporating like water under the sun. This is called inflation. And gold? Gold doesn't get diluted. The same ounce of gold that bought 10 bags of groceries in 1920 still buys 10 bags today. That's called a store of value. Paper money doesn't do this. So that's problem 1. Your savings are losing a race against inflation that you didn't even know you were running. But everything you just heard describes the surface mechanism. Underneath, there's something happening that most people haven't noticed. A behavior pattern that central banks are repeating year after year. And the pattern is accelerating. Here's the behavior that stands out. Central banks are buying gold at record levels, not just buying, accumulating at rates we haven't seen before. 2022, central banks bought 1,000 tons of gold. Historic record. 2023, they bought 1,100 tons. New record. 2024, 1,100 tons again. 3 consecutive years of record-breaking purchases. China bought 300 tons in 1 year. Russia bought 200. India bought 150. Turkey, Poland, Singapore, all buying, each country acting independently, but all doing the same thing at the same time. But here's the part that makes this pattern even more unusual. They're not just buying gold, they're moving it. Taking it out of vaults in New York and London, repatriating it back to their own territories. This is called repatriation. It costs money to move gold. It costs money to build new vaults. It costs money to secure transport. Why would you spend money doing that? Unless holding it in someone else's vault creates a risk you're no longer willing to take. Let me describe what this looks like from an economic standpoint. Central banks are accumulating gold while simultaneously reducing their holdings of certain currencies. This typically happens when institutions expect major structural changes in the monetary system, or more simply, the behavior suggests they're repositioning, moving from one type of asset to another, from paper claims to physical reserves. The scale of this repositioning is what's unusual. This isn't a small hedge. This is 3 consecutive years of record purchases. When the current system shows signs of stress under unpayable debt, when inflation becomes harder to control, when currency trust erodes. Historically, institutions with gold reserves have more options. That's what the historical pattern shows. This is problem 2. The institutions that control monetary policy are changing their behavior. They're accumulating the one asset that doesn't depend on any government's promise. What does that behavior tell you? And the pattern goes beyond just buying gold, because while this accumulation happens quietly, something else is happening in plain sight. The currency that's dominated global trade for 80 years is being used differently. In 1944, the world made a deal, the Bretton Woods Agreement. It made the US dollar the global reserve currency. Every country would trade in dollars. Every country would hold dollars in their reserves. Why? Because America promised each dollar was backed by gold. $35 equals 1 ounce of gold, a direct link. Then in 1971, President Nixon closed the gold window, said, "You can't exchange dollars for gold anymore. The system continues without that backing." And the world accepted it, because at that moment, there was no alternative system ready. But trust in a currency without backing requires consistent policy. And the data shows that trust is measurably declining. China is buying fewer US Treasury bonds than before. Russia reduced its dollar reserves from $96 billion to $2 billion. India is accumulating gold at rates it hasn't since the 1960s. Saudi Arabia is negotiating oil contracts in multiple currencies. These are measurable changes in behavior. When geopolitical tensions rise, gold prices spike. 2022, Russia invades Ukraine. Gold jumps $200 in 2 weeks. 2023, Middle East conflict erupts. Gold rises another $100. 2024, new tariff threats announced. Gold breaks all-time records. The pattern repeats. Tension rises, gold rises. Sanctions announced, gold rises. Policy uncertainty increases, gold rises. Gold doesn't belong to any country. Gold doesn't have a flag. Gold doesn't have an army. Gold doesn't depend on any government's credibility. Gold just exists. And when the dominant currency faces questions about stability, when that currency is used as a financial weapon through sanctions, when that currency expands its supply at unprecedented rates, capital flows to alternatives. And the data shows it's flowing to gold. That's problem 3. The dollar is facing measurable declines in trust after holding reserve status for 80 years. And when trust declines, diversification increases. Here's something most people don't know. All the gold ever mined in human history fits in a cube that's 20 meters on each side. That's it. That's all the gold in the world. Gold production grows 1 to 2% per year. Maybe. Mines are deeper. Costs are higher. The easy gold is gone. Meanwhile, demand is increasing. Central banks alone bought over 1,000 tons per year recently. Jewelry industry needs 2,000 tons. Technology sector needs 300 tons. Investment demand is growing. Basic economics. Limited supply meeting explosive demand creates upward price pressure. This isn't speculation. This is supply and demand. You can't print gold. You can't create gold out of thin air. You have to dig it out of the ground, 1 ounce at a time. And while central banks can expand currency supply instantly, gold remains physically limited. Some people say, but my bank pays me 3% interest. Gold pays nothing. Fair point, on the surface. But there's a concept that changes this calculation. It's called the real interest rate. Real interest rate equals what bank pays you minus inflation. If your bank pays 3%, but inflation is 5%, the math says you're losing 2% per year in purchasing power. Your account balance grows, but your purchasing power shrinks. From 2022 to 2024, central banks raised interest rates aggressively. The Federal Reserve went from 0% to 5%. Economic models predicted gold would fall. Higher rates make cash-like assets more attractive, the model said. Gold went from $1,800 to $2,700. The models were wrong. Why? Because real rates remained negative. Inflation was reducing purchasing power faster than interest was compensating. Gold doesn't pay interest, but gold doesn't lose to inflation either. Gold maintains purchasing power, and that's math that changes the equation entirely. So let's recap what the data shows. Problem 1. Inflation is reducing purchasing power through money supply expansion. Problem 2. Central banks are accumulating gold at record levels for 3 consecutive years. Problem 3. The dollar is experiencing measurable declines in reserve currency usage. Problem 4. Gold is physically scarce while institutional demand is at historic highs. Problem 5. Real interest rates show that safe savings are losing purchasing power. 4 fundamental problems are showing up in the current monetary system, and the institutions that manage that system, they're not just talking about it, they're changing their behavior. They're accumulating gold at rates we haven't seen in generations. You came here to learn why gold went up. Now you can see it's not really about gold. It's about what happens when the underlying system shows stress. Gold is just what people hold when they're uncertain about paper. And right now, the institutions that create paper are holding gold. That pattern tells you something. The question is, what does it tell you?